Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LFI Levered Lines. My name is Kerstin Kubanek. I'm senior reporter at LFI. And with me today is Paul Brodie, who is Global Head of Investments at Liquidity. Thank you for joining me.
Hi, Kerstin. Thanks for having me. Great to be here.
Everybody is talking about AI's impact on software and tech, but nobody really talks about AI's impact on the private credit industry. So what do you expect in terms of an impact on the private credit origination or also data collection?
So for me, it's not a question of if there will be an impact. The reality is it's already here. Asset managers are investing a huge amount into AI, and the level of impact ultimately comes down to application. And this is where the market is being divided, in my opinion, between those who can adapt and move from archaic processes with slow manual underwriting and backward-looking data to a world of more predictive, real-time intelligence. And ultimately, I see that being applied in kind of two different buckets, right? So one is cost optimization, and then the other area is around alpha generation.
And if you think about cost optimization, most people are worried about AI cutting jobs, of course. Do you think that there's going to be a wave of job cuts in the private credit industry? Will there be an impact at all? What do you?
Yeah,
what
it's
do you
a good
reckon?
question. And it's definitely a topic that's been discussed. I think, if I focus on those two buckets in a little bit more detail, right? So cost optimization, that's where most firms are spending their time. It's the lower hanging fruit, let's say, using AI to reduce manual processes to, particularly across back office or middle office actions or activities to create cost savings, right? The alpha generation side of things is arguably more interesting, but much harder to achieve. And that's, using AI and data science to be better at investing. And in private credit, this means everything from sourcing of quality opportunities to being better at underwriting with greater accuracy and a better understanding of risk, and then all around execution and ongoing management of those investments. So, in my opinion, the fear of AI wiping out, credit or investment teams is a bit misguided, right? I think that ultimately around the cost optimization side of things, sure, I could see there being, job cuts perhaps across middle or back office. But in my opinion, AI doesn't replace the investor. It makes them stronger, makes them better at their jobs, right? It's about ultimately spending less time on chasing data, formatting spreadsheets, cleaning up messy financials, a lot of the grunt work, let's say, and focusing more on making better investment decisions.
Yeah, that makes sense. And if you compare the US market versus the European market, especially in private credit, two completely different worlds, right? And from your perspective, what's the difference between those two markets in terms of private credit origination, in terms of data collection, and also transparency? Do you think that the differences will balance out through AI?
Yeah, I mean, it's a good question, right? So I think the US private credit market is undeniably mature. It's probably more digitized. It's more standardized. And also it's a, fiercely competitive market dominated by private equity backed, sponsor driven deals. In Europe, by contrast, it's more of a patchwork of fragmentation, let's say. You aren't dealing with one cohesive market. You're navigating distinct legal frameworks, localized business cultures, also different, accounting standards, etc. So it's a little bit harder to take that, US style cookie cutter underwriting approach when it comes to Europe. So I think that it's not just about being able to collect the data, it's also about having the ability to truly understand and operate in a fragmented landscape. The fragmentation actually, I think, enhances the need for a relationship-driven approach. So even if you are, going to be developing or enhancing your investment approach through AI, for example, I think that the relationship-driven angle, especially in Europe, is going to continue to be critical and be an important part of how we operate in Europe. Think about that friction. It's why there's perhaps more of an opportunity in the European market right now. So, look, a lot of our focus is on financing and supporting growth in later stage technology businesses across the globe. Looking specifically at the venture and technology space, what you'll see is, historically speaking, that if you look at the total amount of venture funding that goes into Europe, historically speaking, about 15% or so of that has been private credit, has been debt, with the 85% being equity. In the US, 25% of that was kind of credit versus 75%. So it shows that like the large portion essentially, which is on the credit and on the debt side of things in the US. And part of that, amongst other things, is due to the more complicated frameworks that exist within Europe. And as a result, a lesser amount of available capital to those businesses. So as this ecosystem matures and as technology improves, I think what you'll find is that adoption will increase in Europe as well. So whilst it's definitely a bit more fragmented, as we discussed, I think it also presents a great opportunity.
And if you think about a time horizon, given the current market conditions, and I don't want to go into macroeconomics or geopolitics because I think it's a very, very deep topic.
Yeah, indeed.
But still, in terms of a time horizon, where do you think the industry will be in, let's say, 6 months, 12 months time? What do you reckon?
Well, I think it comes down to a few different factors, right? So there's definitely a significant amount of, let's say, kind of political and policy related matters in Europe that are really trying to focus on supporting European companies and businesses and provide them with access to capital, right? So there's an ever increasing amount of kind of focus on that. So what that means is that you have, central bodies and organizations like the European Investment Fund, for example, that are much more actively trying to support fund managers to operate in this space in order to support businesses. So I think, if you look at the trend, like I said, a few years ago, it was, sub 15% of kind of total venture funding was on the credit side of things. Year by year, that is steadily increasing, and you're seeing the demand increase as well. So yeah, it's difficult to put a specific time horizon on it, but it's very active and very visible in terms of the kind of the growth or the adoption that's taking place.
And given that everybody is talking about defense right now, which is a huge and growing sector, do you think that this will accelerate the development as well? Do you see some opportunities there? What do you think are the opportunities in that space?
So actually, I mean, look, that's an interesting point as well. Again, if we're thinking about defense and technology in the technology sector in general, the traditional funding models that existed, let's say, especially in the venture capital space, more so than private equity, perhaps, there's a really large question mark right now whether they are as applicable as they were previously, right? So traditionally, you had high margin software businesses that were, once you prove the product market fit, they're infinitely scalable, and there's just a clear route to growing those businesses, right? And that worked for, let's say, the traditional venture capital model, and then the associated, private credit that would come alongside it. Now you're moving into a space where, for example, there's a huge focus on defense. There's also a huge focus on AI as well. And ultimately, these are, let's say, kind of CapEx or capital expenditure heavy sectors, which is somewhat changing the makeup in the funding mix that these types of businesses require. So, yeah, I see defense as definitely requiring a greater kind of adoption or use for the private credit space, but also in terms of AI infrastructure, et cetera, as well. That's really kind of driving a need for private credit, again, in these more kind of frontier technologies in these spaces.
Yeah, that's interesting. And talking about defense, which is, of course, a sector that's heavily government backed for obvious reasons. And do you think that the different jurisdictions in Europe, they do have different approaches as well? Does it play into the whole system, into the whole funding system?
Yeah, so I think when you look at Europe and how I view Europe, right? It's not just one homogenous market, right? Each jurisdiction has its own nuances, legal frameworks, disclosure standards, advisor networks, et cetera, right? Even investors behave, differently perhaps across different markets. Um, I think the key, and where a lot of our focus has been, is combining that local market understanding with, again, if we're thinking about the application of data and AI, a consistent data infrastructure and approach. So, for example, when we connect to, one of our borrower systems, our data ingestion architecture is designed to respect the local compliance boundaries whilst also getting us the data that we ultimately need. Okay. So there's kind of interactions that we have directly with borrowers. But then, sure, you also have within each jurisdiction their own, let's say, funding strategies and vehicles that are also set up to support those businesses as well. So, look, for sure, you need to understand and pay attention to the nuances that are across the region and across the different jurisdictions in order to be, successful in terms of financing and funding those businesses.
Yeah, that makes sense, of course. And looking into documentation, which is a very important aspect of private credit, also origination, execution, etc. Do you expect that AI will also have a huge impact in that space? Is it a positive impact at all? Do we have to worry given the sensitivity of the documentation? What's your take?
Yeah, look, it's a good question, right? I think that, again, if I expand a little bit on that example I gave just there, right? So, for us, when we connect to a borrower, for example, of course, we ingest the data that's available, or they make available to us and that we need for our analysis, for example, but we do it whilst also respecting local compliance boundaries, whilst, let's say, stripping away the noise to focus on, ultimately what's important to us, right? And real-time revenues, customer retention, churn, cash runway, all that information. And you don't necessarily need to infringe on sensitive personal data to understand that credit worthiness. So sure, it's going to be extremely important around the different, let's say, kind of policies and regulations and sensitivities around that data. But equally, I do believe that sure, this the adoption of AI will create a greater amount of transparency and ability to transact and operate on a cross-border basis. It's just about how you manage it in the correct way with the correct guardrails in place.
Yeah, that makes sense. And if people talk about private credit, European mid-market, most of the time they talk about sponsor-backed businesses, private equity-backed businesses. But there is also the sponsor-less part of the market, right, which is ever growing. And do you think that AI will have an impact on origination processes in the sponsorless market segment, because it is quite different compared to the private equity backed space, right?
Yeah, absolutely. It definitely is. And truthfully speaking, this is where I see AI as having, let's say, a more revolutionary impact or a greater impact. The sponsorless market, companies are founder owned, family owned, or maybe have the lack of backing of a private equity sponsor. They could be venture backed, underinvested in versus the private equity space. If you look at kind of the traditional markets, private credit funds love sponsors because the PE firm will do a lot of the due diligence, structures the data, and acts as the financial backstop. But when a company is sponsorless, the traditional lenders, or some traditional lenders anyway, struggle a little bit because the data is fragmented, the origination cost is too high and quite niche. And I think that the adoption of AI helps to change this, which is why it's an area that we've focused on a lot. So we will underwrite the company on its own merits, independent of a sponsor. So we take that raw financial data, we normalize it, we evaluate their true risk, as opposed to perhaps an over-reliance on the sponsor, who they are, how much they've invested, which is why I actually think that the adoption of technologies such as AI, data science, etc., will have a positive advantage on the financing solutions available to companies in this space, because traditionally speaking, they've just been challenging to underwrite and fully understand. And that's why we focus so much on this space and applying our technology here to make a difference.
So I take it more transparency overall?
More transparency, yes, for sure. I mean, ultimately, it comes down to the connectivity that you're going to have with the borrowers that you're going to be working with, right? So it's about creating sustainable solutions that enable you to be able to access and see that data, to be able to operate successfully. And again, that's a lot of the focus and many of the things that we've worked on over the years here at Liquidity.
Thank you very much, Paul. That was very interesting. Thank you.
My pleasure. Thanks.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.